Hello, everyone, and welcome back to live virtual classes from the Board of Studies. I am Kriti Chawla, and I have been taking lectures on transfer pricing. We've already completed 3 lectures on transfer pricing previously, and this is the fourth one where we will be discussing a few new topics. Again, transfer pricing, but a few specific issues relating to transfer pricing. I hope you can hear me, you can see the slides, so we can go ahead. As far as these lectures are concerned, the rules remain the same. So if you have, any questions, just feel free to either unmute yourself or you can put your questions on the chat box, right here. I've been saying this since, day one. If you have questions, as we complete a particular topic, just feel free to post them right there. Otherwise, you can wait for the end of the lecture to post, your questions. Also, if you have questions from previous few lectures, I can take up the questions right now, but just remember that those particular lectures that we've discussed previously, they form the base to what we will be discussing next today. So, without any much delay, I'd like to start with the agenda for today. So, for today, we have a concept which is called as specified domestic transactions. Now, this is where, I kept mentioning it right from day one. I kept mentioning that although transfer pricing is an international tax concept, in India, transfer pricing affects domestically also. It is applicable on some domestic companies also. So what is that concept? That concept is called as specified domestic transactions that we will be discussing in detail today. After that, although we did cover transfer pricing documentation from an Indian perspective, I will, just take you through and, we'll just revise through transfer pricing documentation, from an Indian perspective. And then after that, I will tell you about transfer pricing documentation as is suggested by OECD BEPS Action Plan 13. So that actually talks about a 3-tier documentation structure for transfer pricing. And that is what we will be discussing today. After that, we will be starting up with transfer pricing dispute resolution. This is where we'll briefly, talk about the reference to the transfer pricing officer, and we'll be talking about safe harbor rules. And then there is something called as advance pricing agreement. I'll try, let's see how much we're able to cover. But, this is what my plan is for today. And after that, for the next lecture, which is going to be the last one tomorrow, we will be discussing this concept, which is called as secondary adjustment. And then we will be discussing limitation of interest deduction. This is section 94B of the Income Tax Act. After that, we will be briefly discussing, penalties, which are very, very specific to transfer pricing non-compliance. And my plan after that for tomorrow is to take up your doubts on the whole concept of transfer pricing and also make you practice, a few more questions apart from all the examples that we've, discussed. Although we'll be discussing examples today and tomorrow as well, but then, examples over and above on the entire concept of transfer pricing is what we will be discussing, tomorrow. So yeah, that's my plan for today and tomorrow. So, okay, great. Let's get started with the first concept for today, which is called as specified domestic transactions. This is section 92 BA of the Income Tax Act 1961. Can you tell me what does 92 say? What does section 92 say? This is 92 BA. What does section 92 say? Anyone who remembers? Very basic. I mean, it says something that you can just put in one word also. Yes, that's absolutely correct. It talks about applicability of transfer pricing on international transactions. It just says that whenever transfer pricing is applicable on international transactions, it has to be done as per the arm's length price. That's about it. It just says that arm's length price is something which is followed in India as well. This is, however, section 92BA, which expands the scope of transfer pricing to domestic transactions in India. Now, my question is, do you think, if there is a transaction between two Indian entities, do you think a tax arbitrage is something which is possible? Do you think a tax arbitrage is possible if there is a transaction between two Indian entities? Do you think there is tax avoidance which can be applicable if there is a transaction between two Indian entities? Yes, if the tax rates are different, okay, how can you explain this a bit further? You're on the right track. How can tax rates be different? Okay, that's absolutely correct. Tax rates can be different, but between two domestic entities, can tax avoidance be can happen? All this while in transfer pricing, I give you examples of profit shifting of profits from high tax jurisdiction to a low tax jurisdiction. Do you think a similar concept can happen for domestic situations as well? Yes, it can happen. How? Well, this is the slide that actually talks about how a tax arbitrage can take place in case of domestic transactions. So this is very clear that this slide talks about section 92, and it says that any income arising from an international transaction shall be computed having regard to the arm's length price. Now, this is section 92BA, which basically says that even in case of domestic transactions, there is a tax arbitrage that can actually happen. How? Well, that is because there is something called as domestic tariff areas, and then there is also a non-domestic tariff area in India. So, if you talk about, let's take an example of a company like a company that has different entities in India itself. Now, if it has two units, maybe there is one unit in a domestic tariff area, and then there is another unit in a non-DTA place. Well, then there is if there is a transfer of goods, it can happen that they can arrange the transaction in a way that there is a tax arbitrage that can happen. Just to give you an example, let's talk about those entities, those tax holiday units. I'm sure you've heard about tax holiday units. Can you give me examples, areas? Okay, startups. Yes, that's absolutely one example with the kind of tax benefits that are available to units which are available to startups under certain conditions, and to entities in non-DTA areas. This tax arbitrage actually happens. So let's take an example of an entity wherein it has a group which has two entities out there. One entity is a normal tax paying entity, and the other entity is basically in a tax holiday unit. It's a tax holiday unit claiming tax holiday deductions under a few sections that we will be talking about. Now, if they transfer goods from the taxable units to the entity in the unit, to the entity in a place where there is no DTA, well, that can actually result in tax arbitrage. And to prevent those kind of situations, they came up with something called as specified domestic transactions. Why? Well, that is because there is shifting of profits from a sort of a high tax jurisdiction, a high tax area, to a place where there is no tax, to a entity where there is maybe lesser tax or there is no tax. And the second thing is that this is happening within two related entities. I said that these two entities are part of the same group. This is the reason these are related entities. And because this is a transaction between related entities, they wanted to apply transfer pricing here, but in a domestic situation. This is the reason, just to make sure that there is objectivity in the determination of income between related party transactions domestically also, they came up with this particular concept called specified domestic transactions. Now, it's more like, saying that they've expanded the scope of transfer pricing in India to include specified domestic transactions also within its nature, within its ambit. Now, there is a reason that I have struck off this particular part here. Can you take a minute and read through this paragraph and just see that I have intentionally struck down this part? Okay, so there is a reason that I have actually intentionally done that, and I will be talking about the reason in this particular slide. When we go to this slide, there is a reason that I have actually kept this in red and struck this down. This is the same thing that I have struck this also here, and this is something that you should remember. Now, when it comes to domestic specified domestic transactions (SDTs), it was actually Finance Act of 2012 that expanded the scope of transfer pricing provisions, and from financial year of 2012-2013, they came up with this particular concept of SDT. But then later on in 16-17, there were a lot of changes that were actually brought about to SDTs, and the scope of SDT was actually brought down tremendously. So we'll talk about that also. But this slide basically talks about why transfer pricing on specified domestic transactions. Because of the tax benefits that are provided in India to specified units, there could be a tax arbitrage situation there also. So this is the reason when you talk about section 92, section 92 2A, this one provides that any allowance for an expenditure or interest or allocation of cost or expense or any income in relation to specified domestic transaction, it shall be computed having regard to the arm's length price. So what they're really trying to say is that even in case of domestic situations, even in case of specified domestic transaction, it has to be computed with respect to the arm's length price. So what I'm really trying to say is that everything that we've discussed, all the methods that we've discussed for transfer pricing, the entire benchmarking exercise, the entire compliance that we've discussed briefly, everything applies to specified domestic transactions also. Now, this is where section 92 subsection 3 talks about this particular concept, that this section would not apply if such allowance or expense or interest has the effect of reducing the income chargeable to tax or increasing the loss, as the case may be. So this will not apply in a situation where after applying the arm's length price, the income reduces or the loss is actually increased. Then this kind of concept will not apply. Do you think this is applicable for international transactions also? Do you think this, what I've highlighted here, do you think this is applicable for international transactions also? Yes, absolutely correct. Because this is what we discussed when we were discussing the first lecture, when we were discussing international transactions, section 92. So this is applicable on international transactions also. If by, applying the arm's length price, there is an effect that it might just reduce the income or, it might increase the loss, then transfer pricing provisions will not be applicable here. So this is exactly the same thing that it says here. Now, this is the slide that actually talks about, sort of the essence of specified domestic transactions. Now, this particular slide starts with, if you look at the right-hand side, this is how it actually starts. It says, for the purposes of section 92, 92C, 92D, and 92E, in case of an assessee, the specified domestic transaction shall mean any of the following transactions, not being an international transaction. So what they're really trying to say is that arm's length price and income of an SDT of a specified domestic transaction, it is to be computed in the same manner that you did for international transactions. Meaning you'll have to compute the arm's length price. Section 92C, which was for the computation of arm's length price, section 92C, which mentions about all the, 6 methods out there, that remains the same for specified domestic transaction also. So those methods are common for international transactions and specified domestic transactions. Then section 92D, which talks about TP study, section 92E that talks about accountant's report, all these things actually are applicable on specified domestic transactions also. So everything, all the provisions are made applicable there as well. When you look at a Form 3CEB, which is the accountant's report, which is also sometimes casually referred to as a transfer pricing return. Don't do that, but call it the accountant's report. But just to make it easier for you guys to grasp, yes, all these forms that we're talking about, they have a specific part there. There is a part C, out there that actually talks about specified domestic transactions, because the rules are, the same for specified domestic transactions as are there for international transactions. Now, the thing is, what are the transactions? When applicable, there is a need to disclose specified domestic transactions. Well, the first one is any transaction referred to in Section 80A. Now, what I've done is I've related this slide to this particular slide to make it easy for you guys to understand what is Section 80A, what is Section 80IA. Obviously, you can look at the law, just see the act, but just to make it, easier for you guys, I've provided it here. So the first transaction that SDTs actually refer to is Section 80A. What is Section 80A? Well, Section 80A is inter-unit transfer of goods and services by an undertaking or unit or enterprise or eligible business to other businesses carried on by the assessee for consideration not corresponding to the market value on the date of transfer. What they're really trying to say is that if there are, eligible units, tax eligible units, tax holiday units, and there are other units that are carried on by the assessee, if there is an inter unit transfer between these two, and it's happening at not a market value, it is not happening at market value, well, then that is where Section 80A will be applicable. So any transaction which is referred to in Section 80A. Then transfer of goods and services between in Section 80IA 8, 80IA 10. Now, 80IA 8 and 80IA 10 talks about deductions for industrial undertakings or enterprises that are in industrial infrastructure development. So if there is transfer of goods or inter-unit transfer of goods between eligible units and other units, or eligible units and other persons, and this is for industrial undertakings or it is for infrastructure development, well, then Section 80IA will be applicable. And if Section 80IA transactions are there, well, then SDT provisions will be applicable. Any questions till now? Any questions? Okay. So do we need separate financials, for units? Well, there will be separate, there will be, guys, there is a comment before I answer your question. There is a comment there that I'm not audible. Can you guys hear me, right? Okay. Okay. Thank you. So, thank you. Just to answer your question, we need separate financials for all these units. There are separate financials, for all these units, specifically if there is a unit, in a different, area. Otherwise, what you'll find, even if there is not, what you'll find is something called a segmental analysis. There is a segment, there is segmentation which is done for all these things, and that is the kind of information that we use to identify, whether SDT is applicable or not. Documentation, yes, you'll have to prepare all the documentation. So all the documentation that we discussed in the last lecture, a TP study, Form 3CEB, all that documentation is something that you'll have to maintain even for the purposes of SDT. There are no two ways about it. So yeah, that's what is applicable. Okay, The next kind of transaction that they actually talk about is any transaction which is referred in section 10AA, chapter 6A and section 10AA. So these kind of transactions are for newly established units in special economic zones. So any business, any transaction which is referred to section 10AA, these newly established units in special economic zones, they will be applicable there as well. Obviously, you should go through these detailed sections. You can go through them. 80A, 80A, 80IA, 8, 10AA. You can go through these particular sections. But if you look at the provisions of SDT, it just says that if there are transactions which are referred to 80A or 80IA, 8, 10, etc., then those transactions would be covered. So when you actually practically, when you actually pick up the financials of these units or these entities, you'll have to correspond whether they're claiming these kind of deductions or not, whether they are claiming section 10 AA kind of deductions or not, or section 80 IA deductions or not. And then if yes, then you will have to see whether these particular transactions have happened at market value or not. Even if they have happened at market value, you'll still have to give a certification because transfer pricing provisions would be applicable. So you'll have to justify in any case out there. The next thing that they actually talk about, and this is something which was, it's been a while, but still I'd say it's newly inserted, is section 115 BA-B6 and section 115 BAE. So this is where, they talk about new manufacturing domestic companies, and they talk about new manufacturing cooperative societies. So whenever you see, transactions between a company which has opted for BAB and any other person with whom the company has close connection. So a company which has opted for 115 BAB, and there is another person with which the company has close connection, or a cooperative society which has opted for BAE, 115 BAE, and a person with whom cooperative society has close connection, then transfer pricing provisions SDT will be applicable. Now, there are two things here that I want to explain. They talk about a person having close connection with that particular company. I'm sure that the definition of person is very wide when it comes to the Income Tax Act. So a person could be anything. It could be an individual. It could be a firm, AOP, BOI, company, LLP, partnership firms, etc. Anything. So that particular definition is very wide. And the second thing that I want to tell you about here is that you will see the wordings which are close connection. This is the kind of wordings that have been used. Now, the thing is that for the purposes of SDTs, they have not defined what exactly is close connection. And so we'll have to go with, the generic meaning. We'll have to go with the definition of close connection as is coming from, different cases, etc., or other act. And whenever you see that there is close connection in terms of control, management, capital, etc., you'll see that SDT provisions would have to be applicable here. So yes, these are the transactions. It also says any other transaction as may be prescribed, but nothing has been prescribed as yet. So these are the transactions on which SDT provisions would be applicable. Now, the thing is that there was a point in time when they introduced these provisions in the year 2012. There was a point in time that they had introduced this section also. It says any expenditure in respect of which payment has been made or to be made to a specified person. This was exactly section 48(2)(b). What was 48(2)(b)? It basically said about specific expenditures which were made to specified persons out there. So every time that there was an expenditure that was made to a specified person, SDT would have been applicable. But it was the Finance Act, the financial year 2016-17. It removed this particular provision from there, and now SDT provision more or less and generally, very casually, it's only applicable to entities that are claiming some kind of tax holiday. So these are the entities on which SDT provision is now applicable. This was the provision that has been uh, struck down. Now, another thing that I want to explain is that there was a time when in 2012 they came up with SDT provisions. They said that what you will have to do is add up all these transactions on which SDT is applicable. If you feel that the threshold is more than 5 crore rupees, well, then SDT provision will be applicable and you'll have to do, you'll have to undertake all the compliances. Now, when they made this change in 2016, they also made a change to, the threshold. Now the threshold is 20 crores in 1 year. So only if there are tax holiday unit, these kind of transactions, and the aggregate amount of the transaction, when you put all these transactions together, the aggregate amount of all these transactions, it exceeds 20 crore rupees, only then there will be a need to benchmark SDD transactions. So beyond 20 crore, you'll have to undertake all the compliances. Till 20 crore rupees, there is no need to undertake the compliances. SDT will not be applicable. The reason that I said that, there has been, a drastic reduction of the scope of specified domestic transaction is because there was a time that this provision was also applicable on SDTs. So any expenditure and these kind of transactions are a lot in any organization. Also, the threshold was 5 crores. But now this has been removed and the threshold is also increased to 20 crore. So the scope of SDT is relatively less as compared to what it was, before. So that's basically specified domestic transactions. This is just a slide that talks about what is an AE with respect to specified domestic transaction. It's the same thing. It talks about all these units which are claiming, which are referred to in section 80A, 80IA, 80IA 10, or any other unit which is referred to in section 10AA, etc. So everything that we've discussed. This is the slide that, in the notes, it also talks about close connection, which has not been defined under the Act. But then if you see any person who has significant influence control, it's basically a person with close, connection. Now, this is something which is very generic, for which we do not have, much in the law itself. Before I just get on to the summary and explain again in concise terms what SDT was all about, any questions here? Any questions? Okay, so this is the slide that actually talks about the applicability of specified domestic transactions. If there is an assessee and the assessee has two units, there is an eligible unit and there is a non-eligible unit, and there is inter-unit transfer of goods and services between these two units of this particular assessee, well, then SDT provisions will be applicable. Alternatively, if there is an assessee which has an eligible business and it has transactions with other assessee, any business transactions with other enterprise with which it has a close connection, well, this is the eligible business, and the eligible business has business transactions with other assessees with which it has close connection, well, then also SDT provision will be applicable here, as long as the transactions are the ones that are mentioned in section 92BA and there is a threshold of 20 crore rupees which is crossed. This is another slide that talks about when SDT provisions are applicable. So in this, why don't you take a minute and just go through this? Take 2 minutes and then I'll explain this. I think this just summarizes the entire concept of SDT in a very effective manner. So just take 2 minutes and read through this diagram. Okay, so um, this particular diagram just talks about whether the assessee is claiming specified deductions as in ATA, ATIA, 10AA kind of deductions. No, then no domestic transfer pricing will be applicable. If yes, you'll have to check whether the assessee has entered into transactions with those eligible units or any other person with which it has close connection. If yes, then you'll have to check whether such transaction is considered as an international transaction. Because if it is an international transaction, then SDT will not be applicable. If no, well, then you will have to check for the aggregate. The aggregate of all those transactions should be more than 20 crore rupees. If yes, well, that is where you'll have to maintain the documentation, which is provided in section 92D, which is, the TP study. And after you do the TP study, you'll also have to file Form 3CEB to report those kind of transactions in Form 3CEB. So this is what you'll have to check for the purposes of SDT. First, whether it is claiming deductions, then whether it is an associated entity, and then the threshold is to be checked for the purposes of SDT. Any questions? Okay. Any questions with respect to transfer pricing documentation? Sorry, with respect to specified domestic transactions. Okay, if there are no questions, we'll move to the next concept, which is transfer pricing documentation. Now, transfer pricing documentation is something that we've already, discussed very, very briefly. I told you about the documentation structure that we have applicable in India. But very, very briefly, this is basically the importance of transfer pricing, documentation. Two things, well, you'll have to adhere to the legal obligation of maintaining that mandatory information because, there are thresholds that you have to meet. And then it also helps in substantiating or justifying the transfer pricing policies at the stage of department revenue. So can you tell me the two documentations that are to be maintained? Are these the same documentation as in international transactions? Uh, I did not get it. I did not get your question. Are these the same documentation as in international transactions? Can you unmute yourself and, just if you can speak up? Okay, so these are basically the documentation structure that you will have to maintain for the purposes of international transactions and for specified domestic transaction also. Now, when it comes to there are answers there, master file and country by country reporting. This is something that we'll discuss here. But I wanted to actually talk about transfer pricing documentation from an Indian domestic standpoint. This is something which is still international. India has incorporated it, but if you talk about what is the documentation which will be applicable now that there is international transaction or specified domestic transaction, well, then there will be something called as TP study documentation, which is provided in section 92D. And then there is section 92E that talks about Form 3 CEB, which is also called as accountant's report. So what I'm really trying to say is that the moment you see that there is an international transaction that you have undertaken, which will now have to be reported, it is these two documents that you will have to maintain, 92E, Form 3 CEB, and you'll have to maintain a transfer pricing study report. Also, if you see specified domestic transaction that you have undertaken, then you will have to maintain a Form 3 CEB and you will have to do a transfer pricing study report. Now, when you look at a Form 3 CEB, which is also called as accountant's report, I mentioned that this is also, all this while I've been saying that transfer pricing return, we also call it transfer pricing return. This is exactly, what I was actually talking about. Don't call it transfer pricing return, but yeah, okay. Accountant's report, it's also called as Form 3 CEB. Now, this is a document which you'll have to, as a taxpayer, take from, a practicing chartered accountant, where they will give and they will certify that the value of the international transaction or specified domestic transaction which has been undertaken, it is true and correct as per the books of accounts and as per the transfer pricing documentation. So it provides a true and fair view. It also says that the value of international transaction and specified domestic transaction is at arm's length. So this was the document that I was talking to you about in the last lecture, wherein there will be three parts to it. There will be the first part, which will talk about the general information about the taxpayer, their PAN, their address, etc., and what are the associated entities. And then there will be a drop down menu which will say under which clause, those 13 instances that we discussed. So under which instance is the associated entity associated. So that is what it will be, it will talk about. Then there will be the next part, which will talk about the international transactions. So clause by clause, it will talk about different international transactions that have been undertaken, and it will talk about details of all associated entities with which international transaction has been entered into. And it will talk about these categories of transactions: finished good, traded goods, tangible property, intangible property, service transaction, deemed international transaction, borrowing, guaranteed transactions, capital transactions, cost contribution, business restructuring, etc. All these transactions it will talk about. So when you look at a particular clause there, it will talk about, which is the AE with which you have undertaken this transaction. Give a brief description of the transaction, volume of the transaction as in the quantity, then the amount as per books of accounts and the amount as per ALP. And you'll have to tell them about the most appropriate method which is used to benchmark this kind of transaction. Now, as I mentioned previously as well, accountant's report is very concise, because it will only talk about what method have you chosen. It's not going to talk about, why have you chosen that method and, those kind of details. It will just ask for the name of, that particular method. Now, similarly, there will be the third part in Form 3 CEB that is very, very specific to specified domestic transactions. So if SDT is applicable, then you directly go to, that part 3 of, the accountant's report, the annexure, where it will talk about SDT, transactions. Similarly, for SDT also, you'll have to, tell them what is the unit, what is the AE, what is the category of the transaction for the purposes of SDT. Then you'll have to tell them about, the details of the transaction and what method have you chosen to benchmark that kind of, transaction. So that is all about Form 3CEB. This is the next thing that you'll have to do if transfer pricing provisions are applicable. The next thing will be Section 92D, which is documentation in the transfer pricing study report. Now, if there is international transaction, if there is specified domestic transaction, this is the report that you'll have to maintain. I will be talking about the provisions in a detailed manner today. We'll just read through these two slides also today. But this is what the TP study really contains. Um, if you read through, the manual which has been given by the institute, you will see that all these, what is the content of a transfer pricing study report in Section 92D that has been provided in a detailed, manner. It lists down everything. So it's not, that I'm talking about all these TP study report, etc., from a practical perspective only. This is also, you know considered for an examination perspective, that it will, even the manual talks about the content of the transfer pricing study report. So, looking at a TP study which has to be maintained, well, it talks about first the ownership structure. So you will give details with respect to, the taxpayer. Then you will talk about the associated entities of the taxpayer. What is the business of the taxpayer, where it is located? What is the business of, the associated entities? Where are those located? And how are they related? Under which instance are they related? Sometimes we also give them an entire ownership structure to, just provide it in a very, concise manner, how the entities are actually related. Then you'll have to give them, something like an industry overview, which is the industry under which the taxpayer operates. Why do you think we have to tell them about the industry under which the taxpayer operates? So, like for an example, if the taxpayer is an automobile manufacturer, we'll have to tell them about the automobile industry. Why do you think that's essential? Okay, methods. Uh, Any other reason? Comparability. Yes, that's absolutely correct. For methods, for comparability. Why? Because all this while we've been saying that we'd like to find out independent parties, like to find out comparables, which are very, very closely, comparable to our taxpayer. That is where we'll have to tell them what is the industry under which the taxpayer really operates, and the comparables will also belong to the automobile, sector, that ways. Then there will be transaction specific details. So this is where we will talk about, what is the first transaction that has happened. So if there are multiple transactions, we'll create different sections out there. The first section will be first transaction. What is the transaction? What is the AE with which the transaction has actually happened? Which is the tested party? Now that you're using, let's say, a TNMM method, etc. What is the tested party? What is, the method that you're actually using, the most appropriate method. Now, it happens, when we make a TP study, because it's a very detailed document. If we tell them that TNMM method is something that we have chosen for the purposes of benchmarking this transaction, we also tell them that why CUP was not, correct. So we give them reason to reject CUP method. We give them reason to reject cost plus method. We give them reason to reject, the resale price method, reject PSM method, reject other method, and then give them reasons on why we feel that transactional net margin method is the most appropriate method. And that, kind of detail makes TP study a very, very, detailed, extensive document. Then we will talk about, the entire computational analysis with respect to a particular transaction. So how have you benchmarked that transaction? Is there a database that you have used? Extensively give them the search criteria, the search codes that you used in the database, the quantitative and the qualitative filters that you used, the accept reject matrix that you, made, etc. Any TP adjustment that you made, etc. All those details, they go, and then you finally justify that transaction is at arm's length or not at arm's length. Similarly, if there is a second transaction, you do the same exercise for the second transaction. Maybe there is COP which is applicable for the second transaction. So then you reject other methods and accept COP method with reasonings. And what you also do is, if you're using COP, you also give them details on the comparable that you're using, which makes COP method the most appropriate for benchmarking. So this makes the entire TP study a very, very detailed document. Now, when you read through section 92D, read with rule 10D, that is where it actually talks about a threshold limit. This is where it says that if the aggregate book value of international transactions, it does not exceed 1 crore rupees, well, then it's not mandatory to maintain the prescribed documentation. However, you still need to substantiate that the income arising from international transaction with associated enterprise as disclosed by the account is in accordance with section 92. So there are a lot of things that are actually coming from this particular paragraph. The first thing, obviously, we discussed in the last lecture also. The first thing is, the threshold. Now, the threshold has to be, 1 crore. If it is less than 1 crore rupees, then it's not mandatory to maintain this, kind of information. The second thing is that while Form 3 CEB is to be filed with the income tax authorities, the idea under Section 92D is to actually maintain the TP study. So you'll have to keep the TP study maintained and with the taxpayer itself, and it's going to be used later on, if the case goes under scrutiny, etc. So today the requirement is to maintain, this particular documentation. But then, even if there is, the threshold is not met, then also you will have to substantiate that the international transaction is at arm's length. How will you substantiate that? I mean, you're as a let's say as a chartered accountant, we are filing form 3 CEB, for someone, and we are saying that this is TNMM that we are actually using. Well, for that also we need documentation to exist so as to tell them that yes, we have done our exercise, we've done all the margin analysis, computation analysis to show that a particular transaction was at arm's length. You need that kind of information. Otherwise you cannot just tell them that randomly a TNMM method is something that we're using to benchmark. So even if this threshold is not met, well, we still have to substantiate that it is at arm's length. There is also a period of maintenance of a TB study. It's actually 8 years. It is to be retained for a period of 8 years from the end of the relevant assessment year. So this is something that you'll have to keep in mind. This is a slide which basically says that in case, today you have maintained a TP study, what happens the next year? Well, next year, they say that you don't have to really, no fresh documentation is required. But if there is a change in international transaction, if there is a change in assumption, or if there is any change in the factor which can influence the transfer price, well, then you will have to, undertake a fresh documentation under TP study. But then, even otherwise, if you look at the entire benchmarking exercise, we remember we do it for 3 years, 1, 2, and 3 years. So that is something, that computation is something you'll have to undertake every year in any case. Also, the margin of the company might change, the next year, might not. So you'll have to keep that in, mind. So while the law says that no fresh documentation is required unless there is a significant change, but then this benchmarking exercise, this benchmarking analysis of, finding out comparable companies, that is to be, done every year in any case to make sure that there is compliance with Rule 10D. So yeah, that is basically the TP study. Any questions now? Okay, any questions? Okay, if there are no questions, I'd like to start with, the next step. it's going to take some time, and this is basically called as the three-tier documentation approach from the OECD. Now, this has been, Form 3CEB and TP study has been running in India as a transfer pricing compliance, since a long time now. Now, OECD came up with Action Plan 13. I'm sure you've, studied BEPS action plans already. So one of the BEPS action plans is transfer pricing documentation, country by country reporting. And this is BEPS Action Plan 13. Now, if you look at OECD BEPS Action Plan 13 report, it says that there is a three-tier documentation structure that has to be maintained. They basically say that if applicable, looking at a particular threshold, if you see a multinational company on which transfer pricing is applicable, well, then it should maintain three kind of documentation. One, you have to maintain something called as a local file. Second, you'll have to maintain something called as a master file. And the third thing you'll have to maintain is something called as a country by country reporting. Now, what are all these things? The first thing is something called as a master file. This is, the table which is coming from the manual, and this is what the OECD basically says on the three-tier documentation structure. So let's see what exactly are these documents. The first thing is something called as a local file. Let's talk about a multinational company which is headquartered in India. Now, this multinational company headquartered in India has a lot of entities within it. It has an entity in Germany. It has an entity in China, and it has an entity in the UK. I'm going to write it down so that we don't forget it. Headquarters, that is India, and AEs, subsidiaries, etc. There's a reason that I'm actually putting it down. It's in China, Germany, and let's say the UK. Now, what happens is the first thing that OECD says is that you will have to maintain something called as a local file. What is this local file? Well, local file is basically like an entity specific document. So one local file will have to be maintained by India. One local file has to be maintained by China. One local file by Germany. One local file by the UK entity. What will it contain? It will contain very, very entity specific information. So it will say that, if India has entered into a transaction with Germany, there will be details on these kind of transactions. If China has entered into a transaction with, let's say, UK, these transaction specific details will have to be put in the local file. So whatever are these material related party transactions, they'll have to be put in, the local file. And the local file will do like an entire, benchmarking analysis of all the details of those kind of, transactions. So this is one file that has to be maintained, and it has to be maintained by all the entities in the group separately. So India has its own local file, China its own local file, Germany its own local file, and UK has its own local file. And every entity will have to file this local file with their local tax authorities. So India will file the local file with Indian tax authorities, and Germany will file the local file with local tax authorities, German tax authorities, etc. So my next question, which has already been put in the chat box here, is: do you think local file is the TP study? Yes, from an Indian perspective, local file is basically something called as the TP study. The next thing is something called as the master file. Now, master file is something which is like a very, very, high level overview of the business. So it's going to give, like a very, very high level information with respect to the supply chain, with respect to value drivers, what are the transfer pricing goals and the policies of, the company, what are the global allocation of income, and, what are the R&D centers. So, from a holistic perspective of it will give information of the group itself. I'll talk about master file from an Indian perspective here, but from an OECD perspective, yes, it's a very, very high level overview of information relating to the multinational company altogether. And this is to be again filed with local tax authorities. Now, the third thing that has to be filed is something which is called as the country by country report, CbCR. Now, CbCR is more like, an aggregate tax jurisdiction wide information. This is one report which is to be filed, in the parent's jurisdiction. So who will file it? In our example, it's going to be the Indian entity, which will actually file it with the Indian tax authorities. Now, if you look at the CbCR, which is the country by country reporting, it will say it will be filed with the parent entity, which is India in our situation, and it will actually say that when it comes to China, this is the revenue that they're earning in China. This is the profit before income tax. This is the income tax paid. These are the employees in China. These are the tangible assets in China, etc. Then for Germany, this is revenue, PBIT, income tax paid, employees, retained earnings, assets in Germany. And then for UK, these are all the information. This is the revenue. This is the income tax that we are paying in the UK. These are the employees that are there in the UK. This is the tangible assets that we have in the UK. So what they'll actually do is give that information to Indian tax authorities in the form of something called as CbCR. And it's going to be filed by the parent entity of the multinational group, and it's going to be in the country of the residence. So this is the reason I said that it's going to be filed in India. Now, can you tell me what do you think is the relevance of CbCR? Why are they doing that? And this is just one document for the entire group. What are they trying to do with CbCR? Illegal business reporting catch up. Okay. Minimum tax. Okay. A lot of things. Yes. Anything else? Well, if you look at it from a CBCR's perspective, yes, what you've actually written is, all true, but how is it actually happening? Well, when they actually file the CBCR in India, do you think they can actually relate the entire thing to, the local file out there? So if let's say the CBCR in, India, it actually says that for the purposes of China, this is the revenue in China, and these are the employees, that you have in China. What they can actually do is relate it back to the local file that they have in, China. That whatever they've actually filed with respect to the local file in with the local tax authorities. So what they're actually trying to do is, sort of relate the information that has been provided in the local file with a high level overview, which is basically the CbCR. So this is what they're really trying to do, and all this is possible with the help of something called as tax information exchange agreements. Tax Information Exchange Agreements, TIEA. Also exchange of information, Article 26, that is provided in the tax treaties itself. Also with these, agreements. So what the Indian tax, if you look at it from the Indian perspective, what they're actually doing is sharing information with other jurisdictions on, request base or on an automatic, basis. This is also provided on the website, the Income Tax Department's website, also on how information is shared with other, jurisdictions. But because of information sharing, this is all is actually possible. So what they're really trying to do is match the information so as to make sure that everything is in sync and there is no tax leakage, which is actually happening, from a multinational's perspective. So this is what they're really trying to do. This is what is provided in the manual, and this is one of the questions coming back to an examination perspective. This is one of the questions that was also asked, in one of the exams. What are the advantages of these three-tier documentation structure, which is provided by the OECD? The first thing is that taxpayers will be required to articulate consistent transfer pricing position. What do you think is meant by consistent transfer pricing position? One word. You can use our example to substantiate it. Okay, so what they're really trying to do is, just trying to make sure that whatever is provided from in the China local file is consistent with what the CbCR basically says. So there is consistent transfer pricing position which is provided. Then tax administrations would get useful information to assess transfer pricing risk, because everything is provided there. So if there is any discrepancy which is noticed, sorry, it can be just taken care of, and tax administrations would get that particular information, and they will also be able to make determination on where resources can be most effectively deployed, and if tax audits are called for, provide information to commence and target audit inquiries. So this is where in case of tax audits also, this is going to be very useful information. So these are the advantages of this three-tier documentation structure from the OECD. You can take a minute and just read through this table which is provided in the manual also, and just sync it with what we've discussed till now. I'm coming to how these other documents are filed in India. Master file CbCR. Just give me some time. I have the Indian perspective in other slides. I'm going to just take a minute. But right now, I've just explained the concept from an OECD perspective. Okay, so this is what the manual says. Now, this is a tool, just a very uh, just a concise form of how these things are applicable in India. What I've done is I'll explain these three things in a lot of detail, but this is one diagram that will help you talk about all these in a concise form. So let's look at local file, because that is what we've discussed till now. So there is local file, and it mentions here that there is form 3CEB, which will report all the international and domestic transactions. And then there is TP documentation, which is the transfer pricing study report, which is Rule 10D and Section 92D, which is regulating the local file in India. Now we'll talk about what happens to CbCR. Is it applicable in India or not? Well, so when OECD introduced, OECD BEPS Action Plan 13, India incorporated BEPS Action Plan 13 in Section 286 of the Income Tax Act. So they introduced Section 286, and if you read through Section 286, it will talk about something called as country by country reporting. That basically means that even if there is an Indian multinational or, India Indian entity being part of a multinational company, if they are headquartered in India, then with the Indian tax authorities, they will have to file something called as country by country reporting, and this is provided in Section 286. But there is a threshold there. Can you guess the threshold? Threshold for applicability of CbCR. Guesswork. Guesswork is fine. Random guesses. Okay, 100 crore. No, maybe we can go a bit more. Okay, yes, that's absolutely correct. It is 6,400 crores for the applicability of CbCR. So this is section 286, subsection 7, and it says that CbCR will be applicable in India if the international group for that for one accounting year, if you look at the total consolidated group revenue in the consolidated financial statements, that is exceeding INR 6,400 crore. Well, then CbCR will be applicable. Meaning to say that if you look at it from our examples perspective, India, China, Germany, and UK all put together, if the group revenue as reflected in the consolidated financial statements, if it's exceeding 6,400 crore rupees, well, then CbCR will be applicable. And obviously, it talks about this also, the rate of exchange, which is, provided here in Rule 10DB, Sub Rule 7. The next thing when it comes to CbCR is something called as the alternate reporting entity. Now, take a minute and read through this. Does it make sense? What is the alternate reporting entity? This is a concept which is internal to CbCR, alternate reporting entity. Does it make sense? Is it too technical? Okay, so now this talks about a situation. Um, oh, understood. No, but I will explain it again. Sorry. This situation talks about an alternate reporting entity. It talks about a situation. What happens that there is, let's say, a multinational group, and they have a parent entity, but then the parent entity is not filing the CbCR for many different reasons. Let's say the parent entity is resident in a place where CbCR, they have not complied with CbCR, they have not incorporated CbCR, or they face some reporting challenge, or there is some issue or the other. So what they can actually do is that they can appoint a specific member in the multinational group, and what that specific member will actually do is they will file the CbCR in that particular country in which they are obviously resident, and that will be on behalf of the entire group itself. So instead of the parent entity filing the CbCR, it's actually this specific entity. They are called constituent entities of the international group. They will be designated by the group that you file instead of the parent entity CbCR where you are actually resident. So what they'll do is, if the multinational is in a place where the parent entity is not filing CbCR, they can actually tell Indian entity, if the Indian entity is maybe a constituent entity, that looking at section 286, why don't you file CbCR on behalf of the parent entity in India, itself. So it's like a substitute local entity that takes on the CbCR responsibility for the entire group, and they will file it in India itself. So that's basically an alternate reporting entity. When you read through the rules relating to transfer pricing documentation, when you read through section 286, this is one terminology that will appear very frequently: alternate reporting entity. Now, this is the time limit to furnish, CbCR in India. This is subsection 2 of section 286, and it basically says that it's going to be within a period of 12 months from the said reporting accounting year. Now, you'll have to look at the accounting year out here, and within a period of 12 months, you'll have to file, sorry, the CbCR, and this is the form in which CbCR is actually filed. It's form number 3CEAD. And this is to be furnished to the joint director designated by the principal director for every reporting accounting year. But from an Indian perspective, it is only when the threshold exceeds 6,400 crore rupees that CbCR will have to be filed in India. This is the details to be furnished by the constituent entity which is resident in India. Now, if you see a constituent entity which is resident in India, then they will have to, if there is a constituent entity which is resident in India and they are actually, filing, let's say, the CbCR in India, well, then CbCR फाइल करने से 2 महीने पहले they will have to tell the tax authorities that they are the alternate reporting entity. So if the Indian entity is becoming the alternate reporting entity, 2 months before filing the CbCR, they will have to intimate the tax authorities that they are the alternate reporting entity out there, and they will have to do that in form 3CEAC. The next thing is these are the situations in which there will be no obligation to furnish CbCR. And this is where if the international group and they do not have the parent entity in India, they have an alternate reporting entity out there for filing its report. And such alternate reporting entity has furnished the report in India, well, then they will not be entitled to do that, elsewhere. So this is what subsection 5 really says. Take a minute and read through subsection 5, and I will go back to this particular slide after that and explain these things out there. Any questions? Shall I move to the next slide? Okay, so this particular subsection says there will be no obligation to file CbCR in certain cases. Let's say that there is an international group and it has a parent entity. The parent entity is not resident in India. What they've done is they've designated an alternate reporting entity somewhere else, and they have actually, that alternate reporting entity somewhere else has actually filed the CbCR somewhere else, then what they're really trying to say is that if they have an entity here in India, well, the entity in India will not have to file the CbCR here. Why not? Well, that is because the report can be obtained by the Indian tax authorities with respect to the tax information exchange agreement. If that is the situation, they don't have to file CbCR in India. Now, the thing is that because CbCR regulations, because CbCR compliance is there in India also, there could be a possibility that CbCR is required in India. But then this is where they say that if there is an alternate reporting entity that is filing it somewhere else, and if India has an exchange agreement with them, well, then you don't have to file it in India. As long as India gets its information with respect to CbCR, it's absolutely fine. You don't have to. There is no obligation to actually furnish CbCR out there. If you read through the third one, it says no systematic failure in respect of the said country or territory has been conveyed to any constituent entity of the group that is resident in India. That basically means to say if there is a systematic failure out there, that there is no exchange happening out there, well, then CbCR requirement, you may need information out there also. So this is why, they're actually saying it. Exemption is not there for parent itself, as in. This is where they basically say, what if the parent entities exemption is not in case of parent? Well, this is where, well, if you look at the concept relating to alternate reporting entity is an substitute. It's more like a substitute for what the parent entity is actually doing. And this is where, this is for a situation where the parent entity is not resident in India. So we're discussing it from an Indian perspective, that there is already an alternate, reporting entity out there. So this is something which is a very, very specific situation, to a specific case, to a situation where you have an alternate reporting entity, and we're not talking about, the parent entity in this situation. So this brings us to this particular place. This is CbCR. If you read through CbCR, it's the form is 3CEAD. Then there is 3CEAC, which is intimation by the Indian constituent entity of the foreign parented entity. And this is intimation in certain cases. This is the intimation that we're discussing. One is that it is the alternate reporting entity, and the other one is the one which goes, under certain circumstances where there is no obligation, to file. So these are the forms that you need to take care. Now, when it comes to master file in India, this is Rule 10DA, sub Rule 1, where they talk about master file in India. Now, the form for master file is Form 3CEAA. Double A, that is the form for master file in India. Now, if you read through, the form for master file, it has two parts to it. Part A, it is to be furnished by every person who is a constituent entity of an international group. So the moment you are a constituent entity, the moment you are part of an international group, you'll have to furnish part A of Form 3CEAA in India. For part A of master file in India is something which is compulsory out there. Then there is part B, and part B is to be furnished only when these conditions are actually satisfied. What are these conditions? Well, the first condition is that the consolidated group revenue of the international group from the consolidated financial statements, it should exceed 500 crores. And there is, if you look at the international transactions, the aggregate value of international transaction is 50 crore. Or if you have intangible transactions, they should be 10 crores. So meaning to say, if you read through, part A of Form 3CEAA, which is the master file. This is something which is mandatory. And what happens to part B? Part B is that consolidated financial statements, it should be 500 crores. Okay, just look at the chat box. Does it make sense? Part Part B basically says that if you look at the consolidated financial statements, well, there, the consolidated group revenue should be 500 crores. Then the next condition is that if you read through the international transactions, the aggregate value is 50 crore. Or if the aggregate value of international transaction is not 50 crore, you should have intangible kind of transactions and that should exceed 10 crore. So either 50 crore or 10 crore, either can be satisfied, but 500 crore should be satisfied for sure. So there is a plus out here, as in there is an and out here, and there is or out here. So both these conditions should be satisfied, but in terms of these A and B, only one condition can be satisfied. If these are satisfied, if this threshold is met, then you will have to fill up part B also of, the master file. So that is what is provided in terms of the master file in India. Okay, so this is part Form 3CEAA, Part A. It is applicable to all constituent entities, irrespective of the threshold. And this is, Part B, where the threshold is to be met. It is only applicable when this kind of threshold is actually met. Okay, any questions? Okay, the next topic that we have is transfer pricing disputes in India. Let's take a 10-minute break here. We'll come back and start with transfer pricing disputes. Meanwhile, if you have any questions, just go through the manual. Also, if you have any questions, we can discuss it after we get back from the break. So let's get back in 10 minutes. confirm if you can hear me and see the slides? Can you please confirm if you can view the slides, if I'm audible? Thank you so much. Okay. This is where we actually start with transfer pricing disputes in India. Now, when it comes to transfer pricing disputes in India, there are quite a few mechanisms that are available only for the purposes of transfer pricing. So obviously there is a hierarchy that is there. But then the traditional mechanism, and then there is an alternate dispute resolution mechanism, which is available for transfer pricing disputes in India. Now, when it comes to transfer pricing disputes, when they introduced transfer pricing in 2001, the initial years of transfer pricing, it actually witnessed significant litigation, significant to the extent that India was actually considered a transfer pricing litigation rich jurisdiction. It was because this was a new area for taxpayers. There were new tax this was a new area for tax authorities also. But then the learning curve actually changed, and the trend began to change out there. There was a time that initially, the transfer pricing dispute was on so-called simpler topics. So it was more about, comparability analysis. It was more on, the selection of comparables. If the taxpayer has chosen, let's say, a particular set of 12 comparables, the tax authorities would question those kind of comparables, and they would like to introduce, new comparables, out there. Or just accept or maybe reject the set of comparables that the taxpayer has actually chosen. Then it was more about selection of the transfer pricing method. So you can see a lot of litigation in India happened on whether it is CUP that should be selected, or it should be TNMM that should be actually selected as the most appropriate method. Then it was also, as I mentioned, on whether the foreign entity can be considered as a tested party or not, and so on and so forth. But what I'm really trying to say is that there was a time that transfer pricing disputes were on simple topics of comparability. But then now, because the trend has actually changed, you can also see more complex economic concepts that are within the purview of transfer pricing litigation. So today you can see transfer pricing litigation on recharacterization of transactions, on something called as marketing intangibles. So within intangible also, there's a controversy with respect to marketing intangibles. You can read through the Sony Ericsson, Maruti Suzuki, LG Electronic cases with respect to marketing intangibles. Then it is on different financial transactions, so guarantee transactions, borrowing transactions, etc., location savings, etc. So the trend has actually changed with respect to transfer pricing disputes. um, this is an old stat that is presented here, but it actually shows how in 2012, 2013, the kind of transfer pricing disputes that we had in India actually were the highest. And this is the reason, because a lot of cases were actually stuck with the traditional mechanism. There was a need to introduce an alternate dispute resolution mechanism in India. And that is what we will be discussing today. So there are two things that we will be discussing today. One is going to be something called as safe harbor rules. And the next thing that we'll discuss today is something called as APAs, Advanced Pricing Agreements. Before we actually get started, I thought to talk about Section 92CA, and Section 92CA talks about reference to the transfer pricing officer. So what happens, under what circumstances can a dispute relating to transfer pricing be referred to the transfer pricing officer, the TPO, from the AO. So this is where this happens from Section 92CA, and it says that the assessing officer, they may refer the determination of ALP to the TPO, but this is to be done with the prior approval of the principal CIT or the CIT. Now, when the case actually reaches the transfer pricing officer, it will the TPO will actually notify the taxpayer, and it will give an opportunity to the taxpayer to produce the evidence, whatever transfer pricing position they have actually taken, howsoever they have justified, the arm's length determination. They can provide evidence to support that, and then they actually determine the ALP, the TPO. Now, there is a thing that, while the assessment is actually going on, if the TPO discovers any other international transaction apart from whatever has been disclosed by the taxpayer, they can determine the ALP of that also. So it's like a twofold process, that the TPO has, twofold responsibility. First is determination of ALP, whatever is provided in the forms, and they intimate the taxpayer to provide evidence for that, and then if there is any other international transaction that comes to their notice, they can determine ALP with respect to that also. Now, whatever information they have actually gathered from the assessee, or there could be other sources, they have to intimate. They will calculate. They will determine the ALP, and then they will intimate the assessing officer, and the assessee. It is important to remember that the order of this particular TPO, this is going to be binding on the assessing officer. Whatever the TPO provides, the assessing officer will compute the income of the taxpayer in accordance with whatever is the ALP which is determined by the TPO, and then they will pass the draft order. And this is from here it actually starts. The traditional mechanism, the dispute resolution mechanism actually starts from here. AO, then you have you can go to the CIT appeals, or you can go to the DRP. Then there is also ITAT, and then to the High Court, and then to the Supreme Court. So that is like the traditional mechanism that we actually have. Apart from the traditional mechanism, what actually runs is the alternate dispute resolution mechanism when it comes to transfer pricing cases. If you just allow me a minute, in this context, it reminds me, probably I can display a set of slides that I have available to tell you how this is going to be very interesting, how dispute resolution under the normal route is, provided. So this is something, I think going a little beyond, the manual, but if you don't mind, shall I just share those slides? Or we can just continue with the next one, which is safe harbor rules. Okay, so just allow me a minute. Okay, is this visible? Is this slide deck visible? Okay. So this is where it talks about the dispute resolution in India, and this is the traditional route that I was actually talking about. There is appeal, which can be made to the CIT appeals. Under what circumstances? Well, whenever there is an international transaction for which income is to be calculated, whether it is at ALP or not, that determination actually goes to the transfer pricing officer. So whenever they talk about international transaction or specified domestic transaction, that is what goes to the TPO. Coming back, this is the traditional route and this is the modern route. So there is traditional route wherein you can make an appeal to the CIT appeals or obviously to the dispute resolution panel. Now dispute resolution panel is something which is very specific to transfer pricing cases, although they don't mention it extensively in this particular chapter on transfer pricing. I thought I'll just share it. Then there is appeal to ITAT that can be made. Then it goes to the High Court and then to the Supreme Court, obviously on substantial question of law. Now, apart from this, also there are these modern routes out there. There is something called as Board for Advance Ruling. So this is something I'm sure which has been discussed before. This is advance rulings. I take lectures on advanced ruling also when it comes to, I think, the revisionary lecture. I'm sure this has been extensively, covered before. Then there is something called as mutual agreement procedure. Mutual agreement procedure is something which is provided in Article 25 of, the tax treaties. This is an international tax concept. It's not limited to transfer pricing, but it goes beyond. So whenever it comes to, dispute resolution, when it comes to, permanent establishment cases, whether there is permanent establishment that exists or not, etc., those kind of issues actually can go to MAP. Then there is something called as APA that we'll discuss today. And then there is something called as safe harbor rules. So what I'm really trying to say is that this is the traditional mechanism, and with the traditional mechanism, there is also a modern route for dispute resolution that is actually there. I'll share this particular slide later with you guys. I think this is interesting because it talks about what happens when there is an assessment order, how much time can you file to the CIT appeals, then to the dispute resolution panel, then to the ITAT, then to the Supreme Court, and then to the High Court, and then to the Supreme Court. So I think this is interesting. It also talks about the authority for advance ruling, which is now board for advance ruling. Now this is the slide that I wanted to display with respect to the dispute resolution panel. It is transfer pricing matters that can actually go to the dispute resolution panel, and it is an alternative mechanism for resolving transfer pricing disputes. The DRP is required to issue directions to the assessing officer within a period of 9 months from which they receive, the draft order. So this is, just take a minute and, just look at this particular diagram. And then we'll discuss it. Okay, so when you talk about TP documentation which is actually filed, it goes under TP audit, and then there is dispute resolution panel, and then there is CIT appeals. So this is how the regular mechanism actually happens, and this is where dispute resolution mechanism happens. This is where it's 9 months which is provided here for the directions, and CIT appeals, well, it varies with the amount of time that it actually takes, and then to the tribunal, High Court, and the Supreme Court. Now this is where there are new alternatives that are provided here. So instead of taking this particular route, you can actually go in for something called as advanced pricing agreement or safe harbor provisions that we will be talking about today. So yeah, I'm going to just go back to the earlier slides to display. Okay, so coming back to these particular slides to see what exactly are these safe harbor rules. Anyone who has heard this before? Safe harbor rules? Okay, anyone who's heard about safe harbor rules before? Okay, can you tell us what do you think they are? What are safe harbor rules? In a word, I think it's quite possible for safe harbor rules. Okay, so safe harbor rules are basically circumstances which have been provided by the income tax authorities that if a particular transaction it happens at this kind of margin, this is the acceptable transfer price that will be declared. For that particular transaction. It's very complicated. No, it's not. I'll give you an example to explain what are safe harbor rules. Well, all this while we were discussing, when we discussed the TNMM method, I said that, there is an Indian entity which is basically providing IT services to the foreign entity. Now, I said that the margin that they have actually earned is 15%. Now, what you have to do is justify using a transfer pricing analysis, a benchmarking analysis, that 15% follows the interquartile range. In this respect, what is the interquartile range in India? Anyone who can tell me what is the interquartile range in India? Yes, absolutely correct. It's 35th to 65th percentile in India. So now you have to justify that this 15% the Indian entity has earned is within the quartile range. Now, there was a lot of litigation that actually happened on this aspect. The taxpayers, they earned a margin of, 15% as an example from IT services, from ITES, services, etc. And the tax authorities always questioned, most of the time, I can't say always, but most of the time they questioned the percentage, the margin which is earned by these, Indian entities. They basically, while the Indian entities did justify it using a benchmarking analysis, using a set of comparables, the tax authorities would always, come up with their set of comparables, and then, say that probably a 24% or an 18% is something which is, which should be the margin for an ITES service provider. And this is just an example that I'm, talking about. Now, there was a lot of litigation on, this. Most of the litigation, as I mentioned, was traditional litigation and on simpler topics. These were the topics, the margin analysis that I'm talking about, that the margin is inadequate for the Indian, service provider. So it wasn't just restricted to ITES, but even for, research and development service provider on, KPOs and BPOs. This was, the problem area. The taxpayer always, mentioned about lesser margin, and the tax authorities always used to come up with a higher margin out there. So this is the reason they came up with this particular concept, which is called as safe harbor rules. So what they've actually done in the Income Tax Act of 1961 is that they have defined some circumstances out there. These circumstances are: do you provide contract research and development services? Do you provide IT services? Do you provide ITES services? And what they've actually done is, if you say yes, these are the circumstances, well, then they have actually mentioned that if you provide ITES services, then it is going to be 17 to 18% of margin that will be considered as appropriate. And if you earn that kind of margin, 17 or 18% of margin from this kind of, transaction, then that will be accepted by the tax authorities. There will be no litigation out there on that kind of, margin. So in simple words, from the perspective of transfer pricing, it's more like safe harbor rule is more like, some defined circumstances. And if under those circumstances you have earned that kind of margin, that will be very well accepted by the tax authorities. So what they've actually done is provided like a safe harbor out here for the taxpayers to undertake a particular, transaction. A lot of people say like presumptive taxation. Maybe yes. I don't want to relate the two concepts, but yeah, maybe. So from a safe harbor kind of a perspective, if you see, it actually provides certainty, it provides a lot of compliance relief, and it also provides a lot of administrative simplicity. There is a lot of relief, there is a lot of certainty that if this kind of margin is earned by the taxpayer, there will be no litigation going forward with respect to at least the margin which is provided right there. So those are more like safe harbor rules. These are some of the benefits of, safe harbor rules that I've provided here. But just allow me a minute, just read through the benefits and allow me a minute. I'd like to actually display the income tax department's website and show you how safe harbor rules are placed in India. So if you just allow me a minute. Okay. Is this visible? This is Rule 10 TD of the income tax rules, putting it on the chat box. Rule 10 TD of the income tax rules. And this is on the website itself. Can you, is this visible? Okay, thank you. Thank you. Okay, so this is where it actually talks about, let's say that the first circumstance that they talk about is eligible international transaction. The eligible international transaction is provision of software development services, which are referred to in Rule 10 TC. That's another thing. But these are, the circumstances that if it is a software development service that you actually, provide, well, then the operating profit margin declared by the eligible assessee from eligible international transaction in relating to operating expense incurred is not less than 20%, where the aggregate value of such transactions does not exceed 500 crores. And if the transactions exceed 500 crores, then it should not be less than 22%. So, meaning to say that they've given a safe harbor for software development services. That for software development services, the safe harbor, the kind of margin that should be achieved, should not be less than 20% and should not be less than 22%, depending upon the value of such transactions. Similarly, they have done it for information technology enabled services, ITES. They have provided not less than 20%, not less than 22%. Then they have done the same thing. If you see, these are the kind of transactions for which they have actually provided this. This is knowledge process outsourcing. So KPOs that they have actually provided. Advancing of intragroup loans, they have actually provided for that. Providing corporate guarantee, they have actually provided, for that. The commission or fee declared in relation to eligible international transaction is at the rate of not less than 2% of the amount guaranteed. Then contract research and development, as I mentioned. Then manufacture of core auto components, etc. These are uh, intragroup loans that they have actually mentioned about, corporate guarantees, low value adding intragroup services, etc. Provision of contract research and development when it comes to generic pharmaceutical drugs, etc. So they have actually provided a lot of transactions here. And these are the transactions where you can see what is uh, um, declared as per Form 3 CEB. Where did it appear? Well, it basically means that whatever you have declared in, the Form 3CEB, as in the value of international transaction that has happened, and the value, what you feel if it is at arm's length or not. So the value that you have declared in the Form 3CEB, that is what it basically, mentions. So what I'm really trying to say is when it comes to these safe harbor rules, going back to this slide, this is, what it actually talks about. These are the safe harbor rules. So from a generic perspective, these are the benefits that are offered for safe harbor rules in India. First thing is that there is advanced information or knowledge that is actually available. I think you could see the kind of profits or the range of profits that are provided on the website itself to qualify for safe harbor. So that, sorry, certainly brings in, certainty in kind of, these transactions. Then there is an elimination of litigation, because whatever is the circumstance that is defined there, that you have that surety that that will be accepted by the tax authorities. There is automatic approvals, and then there is self-assessment procedures. There are, compliances for safe harbor rules, also the forms that are available. So there is ease in compliance, and then there is obviously reduction in compliance cost, because whatever is provided there, you just following, the safe harbor rules, that are provided there. So there is certainly a reduction in, the compliance cost also. These are some of the eligible transactions, for safe harbor services. So there is software development services, just I think mentioned these, KPOs, PPOs, and then there is low value adding intergroup services, intergroup loans, etc. Even there are specified domestic transactions, even for those which are undertaken by eligible assessee. Even for those, these are the ones, very, very specific transactions on which safe harbor is actually applicable. Now, when it actually comes to safe harbor, there was a point in time when they introduced safe harbor first. There was a lot of uh, uh, perspective that was shared from the industry, that the safe harbor that has been kept by the tax authorities, that was actually very, very high. And with time, they actually brought down the percentages. They brought down the margins to a lot of transactions. What they did going forward also was that they introduced a lot of transactions later on. So if you see these, advancement of intragroup loans, low value adding intragroup services, contract research and development relating to generic pharmaceutical drugs, etc. These were the transactions that were actually added later on. Initially, the transactions were, very, very generic transactions, and later on they added more transactions to the ambit of safe harbor rules. So what I've done is I've provided a link here, what you can do to view the safe harbor rules. Otherwise, it is Rule 10TD, which you should remember for the purposes of safe harbor. And these are some of the examples, that I have provided here, which I just displayed also. Okay, so that was basically safe harbor rules. Any questions? Any questions? Or we'll go to the next one, which is basically advanced pricing agreements. Okay, any questions? Okay, no questions. Uh, oh, sorry, there are questions. No, safe harbor rules will absolutely not eliminate TP study requirement. You'll have to maintain TP study for sure. But, it actually gives you a better mechanism to justify the percentage, justify the margin out there, that it's actually covered by, safe harbors. So if you're following the safe harbor, there is compliance there, but then you'll have to do the TP study for sure. We have to remember percentages. I don't think so. No, you don't have to remember, the 20% and the 22% at all. But you have to, I think it's essential to remember the concept as such on what is safe harbor. I think I don't wait, for you guys to actually uh, type down the question. I'm going to wait. I'm unable to understand how compliance is, reduced. Well, compliance is reduced because you don't have to. It's the entire process of justifying whether this is at arm's length or not. Now, if the safe harbor rules specifically mention it, then you can just use the safe harbor rules to justify a margin that has been earned. So this entire exercise of benchmarking, etc., actually gets resolved. Exactly. So, for the purposes of, safe harbor, there is a form out there. There is form 3 CEFA. I think I'm going to just type it down here. So this is the form that is basically for safe harbor. It is actually used by eligible taxpayers to say that they have actually opted for safe harbor rules for transfer pricing, and this will actually ensure that tax authorities, they accept the declared price for these kind of transactions. So if these conditions are actually met, what I just displayed, it will actually provide those kind of tax certainty. So this is the form that you'll have to do for the purposes of safe harbor, that you are actually opting into safe harbor. And yeah, that is all. Yes, please. You can, I think, unmute yourself and just put down the question, or you can just type it down. Uh, there is a mechanism to say offer to tax, but I think your question is very practical. So, this is something that we can, uh, I think I'd just like to keep it for the last section of this particular lecture. I can address it there. But yes, you can, if you see that you're not able to justify whatever the taxpayer has actually earned, the taxpayer is not able to justify, they can offer to tax, that particular percentage. But this is not academic at all. This is something which is very practical. And this is not basic. Okay. Any other question on safe harbor rules? Any other question on anything that we've discussed till now? Okay, so if there are no more questions, we'll start with the next concept, which is going to stretch for a while now, which is basically called as advanced pricing agreement. Anyone who's heard of this concept before? Anyone who's heard of this concept before? Okay, so the concept of advanced pricing agreement is something which is coming from Section 92CC and Section 92CD. What is advanced pricing agreement? First, at this slide, I'd like to just explain the concept to you guys. just tell you what the concept really looks like, and then we'll read through the slide, because that process will make it actually better. So if you look at the concept of advanced pricing agreement, it is more like the taxpayer and the tax authorities sitting together and negotiating. Now, if when we started with transfer pricing disputes, I told you guys that the disputes in India were, on very, very classic issues. So the disputes in India was on the selection of comparable companies. The taxpayer gave, let's say, 12 comparable companies to justify the transaction, and the tax authorities, they rejected some comparables, then they added some more of their own comparables, and they made it entirely another kind of, set altogether, the set of comparable companies. So the kind of disputes that we had, in India were on the selection of comparable companies. Then the kind of disputes that we had in India, as I mentioned, was on the selection of transfer pricing methods. So because these disputes were, a lot, and what happens is that, let's talk about year one, when Indian company provides IT services to a foreign associated enterprise. Now, this is the business that they're actually doing. So it's going to happen in year two also. And year two also, they're using the same set of comparable companies to justify the transaction. Then this transaction is happening in year three also, and then they're using the same, almost the same set of comparable companies to justify the transaction. So these kind of transactions, they happen going forward out there. Now, if it is questioned by the tax authorities, this is where they wanted to resolve the dispute relating to these kind of issues. And what they did was, they came up with something called as advance pricing agreements. So under advance pricing agreements, it's more like the tax authorities and the taxpayers sitting together, and today they will decide that going forward also, I'll have the same kind of transaction, I'll have the same kind of IT provision of IT services kind of transaction with the my associated entity. And they both, the taxpayer and the tax authorities, they sit together and they negotiate that going forward, when I have these transactions, these are the set of comparable companies that I will have, and you should accept these comparable companies. This is the method that I will use to benchmark this transaction, and that should be acceptable by the tax authorities. So that is more like, that is something called as advance pricing agreement. Today, the tax authorities and the taxpayers, they're sitting together, and they are deciding that going forward, when they have that kind of transaction, even today when they have that kind of transaction, this is what will be acceptable by the tax authorities. These kind of things will be acceptable by the tax authorities. So in advance, they decide that going forward, when they have the transactions, this will be the pricing that will be accepted by the tax authorities. This is the agreement that the tax authorities and the taxpayers come up with, and this is called as advance pricing agreements. Shall I explain this again? Many things. I'm sure there are many questions that are running your mind, but we'll discuss them. But shall I explain this again, the basic concept? Um, Safe harbor rules are something which is not specific to a taxpayer. This is something which is very, very specific to a taxpayer. APAs are very expensive. This is something which is specific to a particular taxpayer. So it's going to be a particular taxpayer that will sort of sit with the tax authorities and, discuss their business. So this is, which is something which is very specific to a particular taxpayer. And this is, this is not even like advanced ruling, because there are a few aspects of APAs that we'll discuss going forward, and so you will understand that this is a little advanced, to advanced ruling as well, a little complex to advanced ruling also, but a few things are there which are more like advanced ruling. Okay, so let's discuss the definition of advanced ruling. The definition of APAs. This is what it actually says. If you read, it says an APA is an arrangement that determines in advance of the controlled transaction, it determines an appropriate set of criteria like method, comparables, adjustments, critical assumptions as to future events for the determination of the transfer pricing for those transactions over a fixed period of time. So it basically says that APA is more like an agreement between the taxpayer and the tax authorities, and it's going to determine an appropriate set of criteria. What is the meaning of appropriate set of criteria? Well, they could determine anything. They could sit and determine, the method, the comparables, or they could, determine the adjustments that they are actually making. Whatever is, the taxpayer aggrieved by, they could actually determine that appropriate set of criteria, and it's going to help in determination of transfer pricing for those transactions going forward over a fixed period of time. So even if you look at, it's going to for sure determine an appropriate transfer pricing methodology for them, and this will actually offer better assurance that whatever is the transfer pricing method that is selected by the APA, that is what will be actually provided. So there will be certainty, there will be unanimity in approach, etc. So that is what an APA really is. This is the slide that talks about the benefits of APA. So for sure there will be greater tax certainty. I think this is something that I don't need to explain. Then it eliminates the risk of audit of related party transactions over APA term, because this is something which is as it is agreed between the taxing authorities and the taxpayers. It eliminates that kind of risk. It is an efficient resolution of recurring complex transfer pricing issues. As I mentioned, a transaction will run over the course of the next few years. So if it is something which is complex, a transfer pricing issue, and it's going to be a recurring issue going forward, because going forward the same position is taken by the taxpayers, this will eliminate that problem. This will give an efficient resolution for those recurring issues. It reduces the compliance burden, because now even for APAs, you'll have to maintain a TP study, no doubt about that. But in the TP study, you can say that this kind of transaction is covered by APA dated this particular date. So what I'm really trying to say is that what happens in an APA is that if you decide that the percentage or the number of comparables or the method is covered by the APA, you don't have to justify it extensively in the TP study. You can just mention that this is covered by the APA, out there. Mitigates exposure to penalty. Then there are long-term savings, because it says renewals are usually less time consuming. Now, I'm going to talk about the fixed term of APA, and then I will talk about renewals also. And this is an alternate dispute resolution mechanism leading to reduced litigation, because this is a modern technique of reduction of disputes when it comes to transfer pricing cases. So that's basically an APA. This is something which is specific to transfer pricing issues. Now, the next thing is the process for APA. How do you really apply for APA? And this is provided in Rule 10G. Any questions before that? Any questions? Guys, are you able to understand? Can you just give me a very small perspective? Am I running too fast? Okay. Okay, thank you. So the process for APA is provided in Rule 10G. It talks about the persons who are eligible to apply, and any person who basically undertakes an international transaction or someone who's contemplating to undertake an international transaction. This is where I said, when you mentioned about advance ruling, yes, even in advance ruling, ahead of the transaction, you can determine how what will be the tax aspect to it. So even here, if you've undertaken an international transaction or going to undertake an international transaction, this is where you can enter into an APA. Now, when you enter into an APA, there is pre-filing consultation that happens. You make an application for a pre-filing consultation. When you have a pre-filing consultation, this is where, in a pre-filing consultation, you don't necessarily have to give a taxpayer's name. Uh, this will just determine, the scope of the agreement. This will just identify the transfer pricing issues, the suitability of the international transaction, and, very broad terms of the agreement you can actually, discuss out there in the pre-filing consultation. And then when you decide that you want to finally go in for an APA, you have to furnish an application in Form 3CED. I will give you a lot of perspective to APA. This is the topic that I actually speak on in transfer pricing. So just allow me some time. When we go through the entire APA rules, I will give you a perspective on what is happening to the APAs that we have in India. So yeah, this is this is how you actually apply for an APA. When it comes to an APA, we'll discuss when it is actually filed, but I wanted to first talk about the validity of an APA. When it comes to an APA, you can actually take it for a period of maximum 5 years at one go. So when you apply for APA, you can get an APA of consecutive 5 years, meaning to say that this is year one, you can get it for the next consecutive 5 financial years, and then you can actually extend it for a further period of 5 years also, but at a stretch you get it for 5 years. Obviously you can get it for less also, but maximum time is for 5 years. Now this is ahead of the transaction. Going forward, you can get it for 5 years. But the interesting thing in India is that you can actually get APA for previous 4 years also. So you can get it. This is year one. You can take APA for whatever has happened before 4 years also. That whatever actually happened in those 4 years, you can get tax certainty for that also. So in India, what is the maximum period for which you can get APA? It's actually 9 years. How 9 years? You can get it for 5 years going forward, and then you can get it for 4 years going backward also. That going backward is called as rollback provision. So in India, we have rollback provisions for 4 years, and we have going forward provision for 5 years. So in India, you can get tax certainty at one point in time through an APA for a maximum period of 9 years. Now, this is the slide that talks about, the APA mechanism, the APA program that was actually launched in India in 2012. And this is, what the fee actually looks like. This is just, the fee that actually goes to take an APA. And then obviously professional fee is something which is very, very, different from this particular thing. So professional fee is different. This is something which is, very different. The kind of fee that we have in India is based on the value of international transaction. It's got nothing to do with the years. It's got everything to do with the value of international transaction. So till 200 crores, it's 10 lakh. Then from 100 to 200, it is 15 lakh. If the transactions are more than 200 crore, it's 20 lakh rupees. And then rollback provision, it is 5 lakh rupees that is to be paid. These are some of the observations, that are there for an APA. Now, when you take an APA and, you sit with the tax authorities, what will it be binding on? Well, it's going to be obviously binding on, the person who's entered into that kind of transaction, who's actually taken that particular APA. And it's also going to be applicable on PCIT or the Commissioner of Income Tax, authorities. The APA shall not be binding if there is change in law or facts out there. Now, if you look at the APA, it is actually based on the set of a few set of assumptions out there. Um, when you actually sit together and when you actually negotiate, APA is obviously based on negotiation and it's based on the consent of those particular signing parties. Now, if you when you actually sit and negotiate, you give the tax authorities a set of assumptions and a set of facts, that these are the set of facts based on which the transaction has actually happened. Now, let's say a particular, you say that I am taking the APA for a transaction of the Indian entity with the US entity. Now, if the entity changes going forward, now the Indian entity has started servicing not the US entity but UK entity. That means that there is a change in fact out there, and so the APA will not be binding going forward. So, what I'm trying to say is that, very similar to advance ruling, the APA has been given with respect to certain facts. If those facts change or if the law changes, then APA will not be binding. Then what is very interesting is that the provisions of the APA, it shall override the provisions of Section 92C, Section 92CA also, which are for the determination of ALP. Now, Section 92C talks about the selection of the most appropriate method, the determination of ALP. And obviously, in APA, they actually negotiate and determine the method to be chosen for benchmarking. So the APA provisions will obviously override Section 92C. It will also override CA, which is 92CA, which is a reference to the TPO. Because this is where whatever is agreed with the tax authorities, this is what will be applicable. This is APA application. The application may be filed at any time in case of this. I will discuss a question which is provided in the manual also with respect to the filing of APA. So just take a minute and read through this, and then we'll discuss the question. Okay, so this is the slide that talks about the application with respect to EPA. It says that the application may be filed at any time before the first day of the previous year, relevant to the first assessment year for which application is made, if transactions are of recurring nature, and before undertaking the transaction in respect of remaining transactions. So let's take an example to discuss what is before the first day of the previous year with respect to APA. Please read through this particular question here. Okay, so this particular question, okay. This particular question actually talks about XYZ Private Limited. They have been supplying to its AEs and they have applied for APA. Now, how does it suggest that this is a recurring transaction? Well, the wording says that they have been supplying, it has been supplying goods to its associated entity. This basically signals that this is going to be a continuing transaction, a repetitive transaction. So we'll have to follow the first, pointer that was provided in the rules. The application for APA was filed on 15th March 2024. APA was signed on 2nd June 2024. What is the previous year from which APA will be applicable? Now, if you actually see, it was filed on 15th March 2024. That basically means that it was actually filed before 1st April 2024, before the 1st April 2024 previous year actually started. It was actually filed, and this is the reason APA would be applicable from the previous year 2024-2025. Why? Because the law says before the first day of the previous year. So because in this particular situation, it was filed before first day of the previous year, which is for the purposes of 24-25, it is 1st April 2024. It was filed before that. This is the reason APA would be applicable from previous year 2024-25. So this is how you need to tackle questions. So we're done with this slide: process, APA application, observations, value, validity, and this is the slide that talks about revision of the APA. Well, do you think an APA can be revised? Yes, the APA can be revised. It can be revised either by the board or either suo moto or on the request by the assessee. It can be revised if there is a change in critical assumptions. What are these change in critical assumptions? Some conditions with which the agreement was actually reached. So if there is a change in those particular assumptions, then you can actually revise, the APA. If there is a change in law, sorry, just going back. Are you talking about this? Remaining transactions? Yes. So remaining transactions, basically, these are already occurring transactions, and then there could be other transactions. Let's say a transaction which has not been undertaken as yet, a transaction which will undertake an international, transaction that will undertake. So this is the reason before undertaking that kind of transaction they have mentioned here. I think it's falling from here. Any person who has undertaken an international transaction, or it is contemplating to undertake a transaction. So for contemplate to undertake that transaction, they have mentioned before undertaking that transaction. This is what it's going to be applicable for. Does it make sense? Well, even if it is, the first time that you're undertaking a particular transaction, it's absolutely, fine. They actually fall under this kind of, transaction. Yes, the second one. That's more like an academic thing. Practically, it's a different story altogether, because this is where I think I've seen a lot of taxpayers that are actually aggrieved of, transfer pricing disputes to go in for, APA. So for recurring transactions. Okay, so coming back, this is where they talk about, how can it be revised? Where can it be revised? If there is change in critical assumption, there is change in, law, or there is change, from the competent authority, that it can actually be revised. But when it is actually revised, opportunity of being heard has to be provided, to the assessee. and the revised agreement will include the date till which the original agreement will be applicable. So you'll see that, whenever APAs are actually revised, you'll see that there are dates out there that, this APA is applicable till here, and the date from which the revised agreement is applicable, that's actually provided on the revised agreement itself. Can the APA be cancelled? Well, very well, yes. If there is failure to comply with the terms of the APA, so there are compliances that have to be undertaken for APA also. There are specific forms that you have to file there. This is called as the ACR, the Annual Compliance Report. If there is a failure to file the annual compliance report by the taxpayer, or there are material errors out there, or then the APA can be cancelled. If the APA is already entered into, and then you want to revise the APA, but there is no consensus that is actually achieved, well, then also it can actually be cancelled. And if APA has been achieved because of fraud or misrepresentation, then it will be void ab initio. So yeah, that's basically APA. Now, I'd just like to, talk about APA from a practical perspective. If you're interested in the subject, you will actually see that, there is always the CBDT. It furnishes something called as an APA annual report. You can see it on, whenever it's you can see it on the website, the Income Tax Department's website, the annual APA report. So if you actually look at the APA annual report, it sort of paints a very optimistic picture for the Indian APA program. They introduced the program in 2012, and it will actually give you a lot of information and insight on the number of APAs that have been signed by India today. It's actually more than doubled, and that sort of from last year, and that actually indicates sort of taxpayers' trust in obtaining tax certainty. If you actually see India, it has been quite a late entrant to the world of APAs. It was only in 2012 that India introduced the concept of APAs. And if you see 11th year, the 11th year after India entered into APA, India had actually filed 516 APAs. Whereas if you look at USA, it achieved this particular milestone in 14 years. If you look at China, China introduced APAs way back in the year 2005. Imagine, we introduced in 2012, China introduced way back in the year 2005. They are still in their 200s. So it's more like a favorable comparison. So if you actually see India, they've actually given a lot of tax certainty to taxpayers by having 516 APAs in the 11th year itself. What is also very interesting is that the tax certainty which is provided in India is 9 years, which is as high as most jurisdictions. So if you see USA, they provided for 6 years. Japan, they start at 3 to 5 years, with rollback, etc. But the kind of time that it actually takes, for India to enter into APA, that's actually a little, more. But then if you actually see, I mean, it takes a lot of time. It takes about 44 months, for India to come up to an APA. It takes a lot of time because that negotiation takes a lot of time, and there are, the process is time consuming. But then if you actually look at the numbers, looking at that, India provides tax certainty of 9 years, which is very, very high as compared to other jurisdictions. I think the numbers are, still very reassuring. So that's the kind of picture that India actually provides for APA. I think when it comes to, I know we should restrict it to an academic standpoint, and from an examination point of view, you should try to cover it. But I think it's a very, very interesting topic if you're interested in dispute resolution and transfer pricing issues. I think this calls for a something that that is very interesting as a topic. So you can read through the CBDT annual APA report. But at the same time, I'm just letting you know that that report is something which is over and above what we've discussed today from an examination point of view. So yes, that is all that I wanted to cover for today. We've covered specified domestic transactions. We covered transfer pricing documentation. What is interesting and what is important is the transfer pricing documentation from an Indian perspective, and also looking at CbCR, how CbCR is applied in India, Section 286, master file. And then transfer pricing disputes. So we discussed one, the safe harbor rules that we have in India, and second, the APA mechanism that we have in India. Uh, Whether in APA's negotiation, tax authorities of other countries is involved. Yes, tax authorities of other countries are also involved, and that is basically called as a multilateral, APA. So there are three kinds of APAs. The reason that I wasn't, getting into these kind of details is because it wasn't provided in the manual. But there is something called as bilateral APA, then there is something called as unilateral APA, and then there is something called as multilateral, APA. So it actually depends on the kind of country that you're undertaking. The first one is something, if Indian entity is involved and they're negotiating with Indian tax authorities, that is unilateral APA. Then there could be a situation that Indian um, entity is involved. Then they are involved with there's another entity, let's say a US entity. So the competent authorities of India and the competent authority of USA is also involved. So that is basically called as a bilateral APA. And if the tax authorities of multiple countries are involved, that's basically called as a unilateral. A multilateral APA. So it actually depends on the kind of APA that has been entered into. But I'm not getting into those kind of details here. So yes, other countries' competent authorities can also be involved. They are called as competent authority. For APA, they have a specific team which is called as competent authority. You will also see this terminology written in a few places, which is called as CA, which is competent authority. Okay, with this, we finish for today. And for tomorrow, what we'll discuss is something which is very interesting, a little technical, which is called as secondary adjustment. And we'll also discuss something called as interest limitation rules. And then we'll discuss penalties. And then I have a few questions that we will be discussing from the manual. So that's the agenda for tomorrow. And with that, we will finish with the entire transfer pricing. I hope I'm able to justify the subject, the learning of this particular subject for you. So thank you so much for today, and I will see you guys tomorrow. Thank you. Yes, sir. Thank you. Good night.